is the principle of once a mortgage, always a mortgage. So basically, I know that a lot of us have been hearing the word mortgage and we all know what it is. But enough for us to talk about that principle, we have to start with the definition of mortgage, types, and some of the laws that govern mortgage. So mortgage is when a person who is in need of a sum of money takes a loan from a particular person, or in taking that loan gives his title or interest in a land or property to that person that they are borrowing it from till he is able to pay back the sum of money. So basically, it is the transfer of your legal right or equitable right interest in a land for a sum of money that you borrowed from till you're able to repay that money. So basically, when it comes to mortgage, we have like two major parties, two major people in a mortgage. We have the mortgagor, which is the person that is borrowing. Then we have the mortgagee, which is the lender, the person that you are borrowing from. And in some cases, we have a guarantor, or a surety. So now we understand now, because subsequently I'll be using the word mortgagor and mortgagee in case, so that you understand that when I say mortgagor, I mean a borrower, and when I say mortgagee, I mean the lender. But I also try to use borrower and lender subsequently. So now that we've discussed and we've defined what a mortgage is, now we'll talk about the types of mortgage. Before we go into that, we need to understand that sometimes when mortgage can arise in the sense that when a person who intends to buy a property does not have the total amount to buy that property, he can borrow from an institution or from the lender. Let me use that word. The borrower can borrow from the lender the money and use that particular land or property as the security for that sum. It could also be another land or property. This one is to understand that for mortgage, you can also use the land or property that you intend on buying with that amount as a security. So now let's go to types of mortgage. Basically, there are two types of mortgage. There is the legal mortgage and there is equitable mortgage. So equitable mortgage is where there's a transfer of equitable interest. Let me try and explain it in simpler terms. It's basically saying that it's like an agreement between you and a person that is not usually written down, and you don't require, it's not like done in like the way of a legal mortgage. Equitable mortgage is just me and you saying that, okay, I need to this also amount and I have this also, I'll give you this also so you can borrow me this also amount. And a legal mortgage, let me explain a legal mortgage first so that I'll be able to tell you the difference. Because a legal mortgage is there's a documentation when it comes to legal mortgage. That is the deed of mortgage. So legal mortgage is where you transfer your legal interest in a land to a person in order to borrow a sum of amount, and the person will hold that interest till you are able to pay the complete total amount. And it is in a written agreement, and in that written agreement it must be registered and stamped, and you must also have the governor's consent. So let's take it back to the equitable mortgage. So that is the difference. The fact that in equitable mortgage the governor's consent is not required, and it's basically is for shorter loans, smaller loans, or for shorter terms. I hope you understand that the difference between a legal mortgage and an equitable mortgage is that a legal mortgage is binded by a deed and it is registered and stamped, and the governor's consent is required, while an equitable mortgage is more or less an agreement between two persons where it does not require any registration, any stamp, or any governor's consent. And we should also know that it is possible for a legal mortgage to turn into an equitable mortgage. Let me try and explain so you don't get confused. You know, I said that a legal mortgage should be registered, stamped, and governor's consent should be approved. Yeah. So in a case where it is not done, those three things are not done, and the mortgage deed is not perfected. That means those things are not done. That is when it amounts to an equitable mortgage. So now let's move on to some of the laws that govern mortgage in Nigeria. So we have the Land Use Act. The Land Use Act is, would I say, the umbrella for property matters in Nigeria. So any property or land matter in Nigeria, you will always know that the Land Use Act is governing that transaction. We also have the Mortgage Institutions Act, we have the Stamp Duties Act, and in Lagos we have the Mortgage and Property Law of Lagos State 2010. So that is basically the one that governs mortgage transactions in Lagos State. So let's go to institutions in Nigeria, mortgage institutions in Nigeria. We have the Federal Mortgage Bank, we have housing corporations, we have insurance companies, we have Lagos State Mortgage Board. We also have commercial banks. Commercial banks as in our regular banks, like, I will not mention some name, but our regular banks that we go to for our day-to-day transactions. So now it is now that we have an understanding of what mortgage is and who a mortgagor is, that is the borrower, who a mortgagee is, that is the lender, the types of mortgages, equitable mortgage and legal mortgage, as well as the laws that govern mortgage and the types and the mortgage institutions in Nigeria. Let's talk about the rights of a mortgagor. Remember, the mortgagor is the rights of a mortgagee. Let's start with the rights of mortgagee. So the mortgagee is the lender. It is the person giving the money to the person, which is usually a commercial bank or a mortgage institute, basically. So some of the rights that a lender has in mortgage is right of action to recover the mortgage sum and interest in court. This is in case where the borrower defaults in paying and the due date is either as elapsed and the person has defaulted and notice has been given. The lender has the right to ask the court for an order to recover the mortgage sum and the interest, because I forgot to add this. Most mortgage transactions, once there is the principal sum, that is the sum you are borrowing, there's usually an interest too. That is what, like a particular percentage that will be placed on the sum that you are borrowing. So now once a borrower has defaulted in paying this, the lender has the right to go to court to recover the mortgage sum and the interest. Another right is the right to sell the mortgage property. That is another right of the lender. Once the borrower has failed to pay the sum in interest and the principal sum, the mortgagee, the lender, has the right to sell the property. He also has an action for foreclosure. He has the right to also appoint the receiver. That is the person that will be in charge of the mortgage property to try and recover the sum and manage the mortgage property in order to recover the sum that the borrower is owing the lender. Also has a right to keep the title deeds, also has a right of consolidation. So now let's go to the rights of a mortgagor, that is the borrower. So he has three rights. That's the legal right to redeem, the the legal right to redeem, the equitable right to redeem, and the equity of the right of equity to of redemption. So the first one is the legal right to redeem. That is, remember we're talking about the borrower now, the person that has gone to borrow money in order to, and has put his land as security. So legal right to redeem. This is the right that the borrower has to be able to redeem his property once the principal sum and interest has been paid. That means that immediately a deed is created, immediately a mortgage transaction has been initiated, you the borrower, the person borrowing the money, have a legal right to be able to redeem your property. That is the right to collect your property, to have back your property once you are able to pay the sum and the interest in total. And this is, this means, doesn't mean that this only occurs where the legal due date has not passed. That is the due date, the date that you put in the agreement, that would be the date that your sum must have been paid. That is, once the date has not passed, you have a legal right to redeem your property on or before the date. Basically, once the due date has not elapsed, that is when you have a legal right to redeem your property. So the second one is the equitable right to redeem. This also occurs. So basically, the legal right to redeem is when that's before the legal due date. So equitable right to redeem comes after the legal due date. That means you have the right to still be able to redeem your property even after the legal due date has passed, even after the date that you are supposed to pay. You still have the right to redeem. You still have the right to pay off your loan and secure the property. And the last one is the right of equity of redemption. This is basically an umbrella that covers the two rights, the legal right and the equitable right to redeem. So the equity of redemption, this is the right given to you to have the ability to redeem your property even after the legal due date has passed. Like throughout, this right exists from the beginning of the transaction to whenever it is that you have paid the sum, and that is even after the due date. And this is where our discussion on once a mortgage, always a mortgage comes up. This is saying that even if I have not been able to pay the sum and the legal due date is up, I still have a right to be able to pay and to also redeem my property. And in order for this, so it's important for us to also notice that in the transaction, in the agreement, there should be no clause. There should be nothing in the contract, that is, no clause that would stop you from redeeming your property even after the date is up. So this is why it is important to go through your documents to be sure, because once there is a clause or there is a clause or anything saying that okay, after so date you have been unable to pay the sum, I have no choice but to sell the land. Once that is in a deed of mortgage, once that is in the agreement, that is a clause and it is void, it is not valid, so it cannot be used. So that is basically what it's saying. So the principle of once a mortgage, always a mortgage is basically on talking on the rights, on your rights of redemption. That right protects the borrowers from losing their land, from losing their property, even after they have even after the legal due date, and they've been unable to pay the total sum. But it's important for us to know that although this equity of redemption is given to protect you, it could also be limited. in the sense not limited per se. It could also come to an end where the mortgagee, that is the lender, takes an order to court for foreclosure or to sell this land, and that is when you no longer have your right to be able to redeem the property. So basically that is the topic for today, and I hope that we all understand that what mortgage is and the rights that you, the borrower, have. That is your legal right, the right that you have between the day you create the agreement to the day the legal due date on the document, and your equitable rights, which is the right to still regain your property once you pay the sum, even after the legal due date. And you should also know that in every legal document, every deed of mortgage, you should always look out for some clauses which are detrimental to you, and one of that is a clause that states that even after the due date and you are unable to pay, that the borrower, that the lender has the power, would have no other option than to sell your land. That is a clog in your, and that is detrimental, and that is invalid, and it cancels the whole principle of once a mortgage, always a mortgage. Basically, a mortgage remains a mortgage until an order for foreclosure has been ordered by the court or sale has been ordered by the court. I hope we've been able to learn something new, and I hope we'll also look out for more and more sessions. Thank you very much for joining me today. Have a blessed day.